Hey everyone, and welcome back to the channel. Are you tired of the frantic pace of day trading, but find buy and hold a little too slow for your liking? Well, you're in the right place. Today, we're diving deep into the sweet spot of the trading world, swing trading. This is your ultimate 2025 guide to unlocking its secrets. So, what exactly is swing trading? Imagine it as catching a wave. You're not trying to ride the tiny ripples like a day trader, and you're not waiting for the massive tide to change like a long-term investor. Instead, you're looking for those nice, medium-sized waves, the swings in price that last anywhere from a few days to several weeks. Our goal is to capture a single significant price move, or a swing, within a larger trend. This style of trading has some incredible benefits. First, it's much more manageable for people with busy lives. You don't need to be glued to your screen all day. You can set up your trades, place your orders, and then get on with your job, your family, or your hobbies. It's about working smarter, not harder. Second, because you're holding positions for a few days, your potential profit on each trade can be much larger than in day trading, and you'll pay less in transaction fees over time. But before you jump in, let's be real. Swing trading ain't a get-rich-quick scheme. It requires patience, discipline, and a solid strategy. That's what we're here to build today. The foundation of any good swing trading strategy is understanding market structure. We're looking for trends. In an uptrend, we see a series of higher highs and higher lows. Think of it like climbing a staircase. In a downtrend, we see lower highs and lower lows, like walking down that same staircase. Our job as swing traders is to buy during the pullbacks in an uptrend and potentially short during the rallies in a downtrend. How do we spot these trends and entry points? This is where technical analysis becomes our best friend. Don't worry, you don't need a math PhD. We're going to focus on a few key tools. First up, moving averages. A moving average smooths out price data to create a single flowing line, making it easier to identify the direction of the trend. A common strategy is to use two moving averages, say a 50-day and a 200-day. When the shorter-term average crosses above the longer-term one, it's often seen as a bullish signal, and when it crosses below, it's bearish. We want to trade in the direction of the long-term trend. So, if the price is above the 200-day moving average, we're primarily looking for buying opportunities. Next, let's talk about support and resistance. These are psychological levels where the price has historically struggled to break through. Support is like a floor where buying pressure tends to come in and push the price back up. Resistance is a ceiling where selling pressure takes over. As swing traders, we can look to buy near strong support levels in an uptrend or sell near resistance levels in a downtrend. These levels give us a clear idea of where to enter a trade and, just as importantly, where we might be wrong. Now, let's add another layer, candlestick patterns. These little shapes on your chart can give you powerful clues about what buyers and sellers are doing. Patterns like the hammer, the engulfing pattern, or the doji can signal a potential reversal in price. For example, if you see a bullish hammer pattern forming right at a support level in an established uptrend, that's a high probability signal to enter a long position. It's like the market is waving a flag, saying, "Hey, the pullback might be over." So, we've identified a trend, found a good entry point using support and resistance, and gotten a confirmation from a candlestick pattern. Are we ready to trade? Almost. The single most important secret to long-term success is risk management. I cannot stress this enough. Never, ever risk more than you are willing to lose on a single trade. A professional rule of thumb is to risk only 1% to 2% of your total trading capital per trade. This means if you have a $10,000 account, you should not risk more than $100 to $200 on any one idea. How do we enforce this? With a stop-loss order. A stop-loss is an order you place with your broker to automatically sell your position if the price drops to a certain level. It's your safety net. For a long trade, You might place your stop loss just below the recent swing low or a support level you identified. This defines your risk from the very beginning. If the trade goes against you, you're out with a small, manageable loss. This discipline is what separates professional traders from gamblers. Now for the fun part, taking profits. Just as we need a plan for getting out when we're wrong, we need a plan for getting out when we're right. A common approach is to set a profit target based on a risk-to-reward ratio. For instance, if you're risking $100 on a trade, you might aim for a $200 or $300 profit. This is a 1-to-2 or 1-to-3 risk-to-reward ratio. This means even if you're only right half the time, you can still be profitable. You can also use key resistance levels or trailing stop loss, which automatically moves up as the price moves in your favor, to lock in profits while still giving the trade room to run. Let's put it all together in a hypothetical example. Let's say we're looking at stock XYZ. We notice it's in a strong uptrend, consistently staying above its 50-day moving average. The price has just pulled back to a previous support level, around $50. As it hits that $50 mark, we see a bullish engulfing candlestick pattern form, indicating that buyers are stepping in aggressively. This is our signal. We decide to enter a trade. Buying at around $50.50, we place our stop loss just below the support level, at $48.50. This means we are risking $2 per share. If we aim for a 1-to-3 risk-to-reward ratio, our profit target would be $6 higher. At $56.50, we place our orders and let the market do its thing. A few days later, the stock rallies and hits our target of $56.50. Our trade automatically closes, and we've captured a nice profit. Or maybe it goes against us, hits our stop loss at $48.50, and we take a small, controlled loss. Either way, we followed our plan with discipline. That is the essence of successful swing trading. To get started in 2025, you'll need a good brokerage account that offers decent trading tools. You don't need a supercomputer. A basic laptop and a good internet connection are all it takes. Spend time practicing with a demo account first. This allows you to test your strategies with virtual money before putting real capital on the line. Keep a trading journal. Write down why you entered a trade, what your plan was, and what the outcome was. This is one of the fastest ways to learn from both your wins and your losses. Remember, the market is constantly evolving, so continuous learning is key. Read books, follow reputable traders, and always stay curious. The journey of a swing trader is a marathon, not a sprint. It's about building a skill set that can serve you for years to come. It's about finding freedom and taking control of your financial future in a way that fits your lifestyle. I hope this guide has given you a clear and actionable roadmap to get started with swing trading. It's a fantastic approach that balances time commitment and profit potential. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our next video. Drop any questions you have in the comments below. I'll do my best to answer them. Until next time, trade smart and trade safe.